Well, happy Friday, everybody. You know, for all this drama on China and Turkey, everything everybody was talking about, we're flat for the week. I'm going to show you some of the sectors that are moving. There is a little bit of weakness in the semiconductors here, but consumer staples still doing pretty well. You know, Coke, Kellogg's, Colgate, Kimberly-Clark, they've had a good few weeks. They're one of the market leaders. Energy's finally showing some activity. Materials are flat. The semis are weak and have been all week. Today it's caused NVIDIA and Applied Materials. Guidance was a little bit below expectations. We don't quite have the asymmetry in the performance of the global markets that we've had in the last few weeks, but the U.S. is still outperforming the rest of the world. So let me show you this week. We're flat on the S&P. Japan and Brazil are only down fractionally. That's good. But Germany's down over 2%. That's very typical the rest of Europe. And China's just had a terrible time, down 4.5% overall. I'll get to that in a minute here. In terms of the outperformance and why we keep outperforming, because the U.S. is the place to be. Let me show you where we stand here. Our earnings, the Q3 and Q4 guidance is still strong. It is not dropping. And that's why our markets are outperforming. And no, even if you take away the tax cuts, we're outperforming the rest of the world on earnings. On investments, you know what's going on with the buybacks. The dividends have been strong. M&A has been strong. The valuations are sensible. We're at 16.5 times 2019 earnings overall. Yes, you've got some narrow leadership, and you've got some China growth concerns. Those are definitely issues. Speaking of China, I said another tough day. We're 2.5-year lows in Shanghai right now. You see they're down notably here. Now, we had Larry Kudlow on yesterday saying China's economy was in terrible shape. I think he might be looking at the Shanghai Stock Exchange, which is down 25% from its highs earlier in the year. The problem is a lot of people have noted that the Chinese stock market doesn't necessarily reflect the state of the Chinese economy here. So retail investors, this has been widely talked about for a while, are 80% of the trading volume. They tend to react very, very short term. They tend to be very emotional, move the stocks around a lot. And household allocation to stocks is fairly small in China. It's only about 4% of household wealth. That's a fraction of what it is in the United States. And the bottom line, the stocks are still not a large enough part of the household net worth there to really make a difference. The economy in China has been growing year after year despite enormous volatility in the stock market. Just bear that in mind. Finally, President Trump talking about asking the SEC to end quarterly earnings reports. I don't think this is a good idea. I think you should ask the question, who wins when less information is available? You get an information asymmetry. Professional investors get more access to more information. The analysts are still going to report. And if Wall Street, the companies don't provide the information, Wall Street will try to move in and fill the vacuum. I think the bigger issue is the mindset of CEOs. Most of them are themselves short-termers. Most are less than 5 years. The CEO compensation drives the behavior, and the compensation is based on the stock price. How about a conversation about that? And maybe that will help things make the stock market a little less volatile. Right now, Sarah, we have down 10 points on the Dow.